Hi, welcome to Peschu's Corner. Today I want to talk about indirect taxes. More specifically, this lesson will compare specific taxes or fixed taxes with ad valorem taxes or percentage taxes. But before we do that, let's just briefly examine the nature of indirect taxes. The reason they are called indirect is because they are not directly collected by the government. We have direct taxes such as income tax or corporate tax or profit tax when the entity that earns income, the individual household or the firm, will be directly giving a portion of his or her earning to the government. With indirect taxes, the government collects the revenue or the tax indirectly, meaning that I would purchase a good, I would spend some money on it, and then later via the seller, the government will collect its tax. Okay, let's begin. So we have specific tax, and we have what is known as ad valorem tax. Now, the specific tax, sometimes it's referred to as fixed, and sometimes it's called a unit tax. So this can be fixed, or it can be a unit tax. It all means the same thing. An example of this could be a tax of $1 per bottle of wine, for example. So example, $1 per bottle of wine. So with this case, the tax will always be $1 no matter what the price and the type of wine we are talking about. Always when we have a bottle of wine, we would have a tax of $1. That is why we call it fixed, or we call it unit tax, because it does not change with the price. Ad valorem tax, on the other hand, is dependent on the price of the good. A good example would be a 20% tax on the price of the bottle of wine. Let's continue with this bottle of wine. So this can be called percentage tax. And our example is 20% on the price of a bottle of wine. So in this case, the tax will be dependent on the price of the product, in this case our bottle of wine, and in the upper case, this one, the tax will always be the same no matter how expensive the wine is. Value added tax is VAT is a general example of an ad valorem tax. In some countries they also call it sales tax. But actually, forget about the sales tax, because a sales tax can also be specific. It's simply an expenditure. This value-added tax, it's a percentage tax. All right, and we can combine these and say that these are indirect taxes. Sometimes they may be referred to as expenditure taxes because they are taxes on our expenditure. And another term that you may also hear would be excise taxes. Excise taxes. Next, I want to talk about the procedure of collecting these taxes. The common practice is that these taxes will be collected initially by the seller. So when we purchase a product, we pay the price plus the tax which is collected by the seller, and then the government would go and collect this tax from the seller, which again explains why we call them indirect taxes, because they are not directly collected by the government. It is interesting to note that according to economic theory, the tax can be collected either by the seller or by the buyer, and then the government would then simply go and collect the tax from the relevant entity. The theory suggests that there will be no difference whatsoever if the tax is collected by if the tax is collected from the buyer or from the seller, and the overall impact on society would be identical. Now, we're not gonna prove this, but basically practice shows that it's a lot easier to collect the taxes from the sellers, and there is a reason for that. The sellers are registered in every country where they operate, and thus we know all the sellers that are active on our territory. Also, the sellers are required by law to declare their incomes, and thus we can observe how many sales they have made, what is the value of their sales, and thus we can collect the correct tax. If the government would have to go after every single buyer to collect the tax, that would generally create a lot more chaos. We would have to be registered as buyers, and it would be a lot more difficult and cumbersome. This is the reason why, in practice, indirect taxes are always collected through the sellers and not through the buyers. Next, I would like to talk about the reasons why the government collects indirect taxes. Nobody likes paying taxes, yet we have to do it. Why do we do it? And there are few general reasons why governments collect these taxes. The first one would be to discourage the consumption of harmful products. So, let's say reasons for collecting indirect taxes. And the first reason is to discourage the consumption of harmful products. The example over here that we can use would be a tax on cigarettes, tax on alcohol, products that are generally considered harmful to society. The next reason why the government imposes these taxes would be to correct existing market failures. I plan to do a separate lesson on market failure, and that will happen sometimes in the future. But generally, when the price mechanism is not operating properly, what we are going to observe is overconsumption or underconsumption in a market, depending on the situation. And we can say, as an example, again, the market for cigarettes. Cigarettes. It is believed that people are smoking more than they should be smoking, and this creates what is known as a market failure. The reason why we call it the market failure is because the price of cigarettes would be set too low, which would encourage greater smoking, and we have consequences of that people are getting sick, they may not be able to function effectively at their workspace or in their daily routines. They may have additional hospital bills in order to cure themselves or deal with any diseases that are related to smoking, and thus we call this a market failure. And again, this will be a topic of a separate video that I will do at some point in the future. A third reason why the government can collect taxes is to collect funds for the national budget. So to collect funds, funds for the national budget. Every government needs to have funds in order to operate. It has its own expenses. It has its administration expense. It needs to provide a whole variety of services such as defense, such as security, such as infrastructure, and all these things cost money. So the way that the government can provide these socially benefiting services is by collecting taxes, and then it will have the funds to achieve its objectives. In some countries, the main share of the tax revenues would come from direct taxes. However, this would require better ability of the government to actually know the incomes of the different individuals or the different firms. And in practice, many governments prefer to actually collect the majority of their tax via indirect taxes or expenditure taxes, simply because it's a lot easier to actually go and see the purchases made throughout the year in every store by every seller, the sales made by every seller, than to actually look at the levels of income that every individual has earned. All in all, it depends on the country. Some countries and governments prefer collecting the majority of their tax revenues from direct taxes, but in many cases it would be the other way around. The majority of the tax revenue would be collected via indirect taxes. Finally, indirect taxes have one negative aspect which we should talk about, and that is that they're regressive in nature. Let's have a look at that next. A regressive tax is a tax which is heavier as a burden on a poor person than it is on a rich person. And let's do an example and you'll see how this works. It's actually fairly simple when we use some numbers to estimate the burden of a tax. So imagine that we have two individuals, individual A, and over here we're going to have individual B. And A's income would be, let's say, $1,000, and B's income would be $100. So B is substantially poorer than A. Imagine now that we have a tax which is an indirect tax. It may be a percentage tax, it may be a specific tax, it doesn't matter, but it amounts to $10. So our tax is equal to $10. Now, the tax as a percentage of A's income would be equal to 1%. So this $10 would be 1% of A's income. On the other hand, this same tax would be 10% of B's income. So we see that as the level of income increases, as it goes from 100 to 1000, this tax will, well, the percentage of the tax, the value of the tax as a percentage of the person's income would begin to decrease, which effectively means that indirect taxes are easier to be paid by richer people and they're harder to be paid by poorer people. And this is one of their negative side effects that we should take into consideration. Next, we are going to have a diagrammatic comparison between specific taxes and percentage taxes. We'll have a specific tax on our left and then the percentage tax on the right. Percentage tax. So this is the price, this is the quantity. And let's start with the specific tax. Imagine that this is our supply and the tax will have an effect on the supply. The reason why the tax has an effect on the supply is because we collect the tax from the sellers. If we were to collect the tax from the buyers, then the tax would have an effect on the demand. But as we collect it from the sellers, will have an impact on the supply curve. And I can have a almost identical supply curve in this diagram as well. Now, the specific tax, as we said, was never changing. It was a unit, some amount of money that we charge for every unit of the item that we are selling. So in this case, imagine that our tax is $1. What this means is that we are going to shift the supply curve in such a way that there will be an equal vertical distance, and this would be equal to $1. So this distance over here is equal to $1. This t is equal to $1. So what this shows us is that with specific tax, the supply curves is being shifted parallelly. And it's always shifted by the same amount of money. It goes, you can think of it as a vertical shift by the amount of the tax. With the percentage tax, it behaves somewhat differently. Because the percentage tax is calculated as a percent on the price, as the price increases, so will the tax. So this over here we can say as P rises, so does the tax. And at low prices, our tax may be low. As we go to higher prices, the tax will increase. And as we continue to even higher prices, the tax will become even more. So this is again, T is equal to, let's say, 20%. Again, T is equal to 20%. T is equal to 20%. It's just that those 20% will have different monetary value as we are changing the price. And the result of this is that the supply curve will begin to rotate. It kind of goes this way, rotates anti-clockwise. So this would be S1, S0. And S1 we can say that is equal to S0 plus the tax. This is equal in both cases. Plus the tax. So we can see how with the specific tax, our supply shifts parallelly, or we have a parallel shift, and with the percentage tax, our supply curve rotates anti-clockwise. A common mistake that I've seen many students make when describing the percentage tax is that they say that the tax increases as the quantity sold increases. Now, this may look accurate, but it's incorrect, and it's something to keep in mind. It is true that as we move along the horizontal axis and we increase the quantity, the tax increases, but this would be a fallacy to claim that if Q increases, the tax increases. This, though may appear accurate, it's a fallacy. It does not explain why the tax is rising. What we are actually observing is this: if the price increases because of changes in the market, maybe the demand has increased and has been shifted to the right, this has two effects. A, the tax is rising, and B, the quantity supplied is increasing. And this shows why students often get confused and they think of an increasing quantity leads to an increase in the tax, but no. The correct explanation would be that an increase in the price leads to an increase in the tax. And it's something to keep in mind if you're asked that question. Finally, let's examine the effect on the stakeholders. In this case, our stakeholders would be in no particular order. We have the buyers, we have the sellers, we can have the government. And let's keep it at this level. So to do this, we are going to have one diagram. Now this will be identical whether you use a percentage tax or a specific tax. I'm going to use a specific tax simply because the drawing is simpler, but at the end I will quickly illustrate it with a ad valorem tax so you can see how it will look like. So imagine that this is our supply. Let's add a demand curve. And okay, this is the original supply, D0 and the original demand. Well, D0 and S0. And in this case, we have an equilibrium price, PE0, and equilibrium quantity, QE0, and this is E0. So the government decides to impose a tax on this good, and we said that we are going to have a specific tax, so there will be a parallel shift of the supply curve. We are going to decrease the supply, and the supply will be shifted to the left. So this will be the new supply, which is equal to S0 plus the tax. And our tax would be equal to this difference between S0 and S1 tax. And notice that this tax does not change, or ideally it shouldn't be changing, at any price levels. Alright, so to examine the effect on this, we are actually going to move the equilibrium from E0 to E1, because with the new supply curve that we have just created after the addition of the tax, the market over here would not be in equilibrium anymore. We would need to decrease the quantity demanded because of the increase in the price, and we'll have a movement along the demand curve until we reach our new equilibrium. So this would be PE1, and let me just mark the tax like this. So this is again the tax. QE1. Okay, so to sum up so far, we have moved from the old equilibrium to the new one. As a result, the quantity that was being purchased in this market fell from QE0 to QE1. We have a decline in the quantity demanded. And the price was increased from PE0 to PE1. Now, we want to be able to compare how the buyers and the sellers were doing before and after the tax, and then we'll throw in the government at the end as well. And if we looked at the before tax situation, this PE0 was PE0. It was the price paid by the consumers. Price paid by the consumers. And price received by the sellers or the producers. Okay, so before the tax, right, this thing is before the tax. Before the tax, the consumers were receiving P0. Before the tax, the producers were receiving P0 and the consumers were paying P0. After the tax, the consumers now are paying P1. So this is paid by the consumers. After the tax. The question is, are the producers receiving PE1? And the answer is no, because the government wants to collect the tax. So what is going to happen is that even though the consumers are paying PE0, the seller would have to deduct the tax from this amount of money and will be able to receive the remaining sum. So let's call this PS for seller. So this would be received by the sellers. So what we are observing is that after the imposition of the tax, A, the consumers are paying more, B, the sellers are receiving less. That's quite important. So the price for from the perspective of the seller has declined, and the price from the perspective of the consumer has increased. The difference between these is the tax collected by the government. And we can illustrate this tax as the area of this rectangle. This would be tax revenue for the government. And if we want to calculate the value of this tax revenue, it would be equal to the tax times QE1. It's basically your standard formula to calculate the area of a rectangle. We calculate the tax times this, one side times the other side. Also, you can think of this as, this is a unit tax, remember. This is per unit. $1 per unit or $20 per unit, depending on what the value of the tax is. And this is the number of units that we're selling, so the total tax would be the per unit tax times the number of units. So we can now have a look at the effect on every individual stakeholder. The buyers, before the tax, consumed QE0 and were paying a price of PE0. After the tax, they're consuming less, they're consuming QE1, and they're paying a higher price, PE1. The sellers, before the tax, were selling QE0, and they were selling each unit for a price PE0, but after the tax, they're only selling QE1, and they're receiving PS, which is less than the original price they were receiving. So definitely the buyers and the sellers are worse off. Okay, these guys are worse off. Now the government is the one that seems to be benefiting from the situation, because before the tax the government was not receiving any revenue, and after the tax the government is receiving a revenue equal to the tax times QE1. So the government may be better off. Now, looking at the situation like this, it seems that the tax is not benefiting anyone but the government. So why do we have taxes, you may ask yourself? The answer to that question is we have taxes because the government would then use these money in order to provide socially desirable services, such as defense, such as security, such as provision of infrastructure, such as education, such as healthcare. So even though this tax is being collected from the buyers and the sellers, and we may complain about it, the fact is that in return we should be receiving a lot of services which otherwise would not be provided, or they would be underprovided. Okay guys, I think this is enough for this lesson. In a nutshell, this was a comparison between the specific and the percentage taxes, and we saw the effect on the stakeholders. But at the end, as I promised, I'll quickly draw another diagram that will show you the same scenario but with a percentage tax, and you will see it is very similar to what we just did. So this is our price and quantity, this is the supply, this is the supply after tax. Notice that we have a rotation. This is our demand, the old equilibrium with the old price, the new equilibrium with new quantity, new price. This would be the deductible tax. So our sellers in this case would be receiving PS, and the green area will be the tax revenue for the government. Notice that at Q0, because the price was P0, the tax is actually greater. So this is tax at P0. This is the tax. Over here we have tax at PS. When we calculate the price PS, when we add the tax, we'll get P1. So a very similar diagram. The only difference is that the supply curve is not shifted by the same amount, but it's rotated anti-clockwise. Okay, I hope you liked this lesson, and if you did so, please hit the like button, or if you want, you can leave some comments in the section below, and I hope to see you again. Take care.